Arizona builders have been offering some of the most aggressive incentives in years. Mortgage rates near 3% on a lot of the quick move-in homes, closing cost credits, design center upgrades, lot premium reductions. If you've been shopping for new construction in Gilbert, Queen Creek, or Santan Valley in the last 6 to 12 months, you've seen it. But I was talking to a builder rep recently who put it very plainly. Come June, it will be a completely different story. That window is closing, and if you're in the market for new construction anywhere in the Phoenix market right now, this is a video you need to watch before you make any decisions. Here's what I'm covering today: what builder incentives are and rate buydowns actually are, why builders have been offering them, why they're being pulled back right now, and this is the part that really matters: how to evaluate whether a builder's deal is actually good for your situation or just a number that sounds better than it really is. I'm Megan Williams, realtor with Blue Collar Homes here in the East Valley. I work with buyers on both new construction and resale every single week. Builder contracts are a completely different animal from a standard resale purchase. And helping buyers navigate that is a big part of what I do. Let me walk you through the real picture. By the end of this video, you'll understand exactly what's been on the table, how long it's likely going to last, and the one thing you need to do before you sign anything with a builder's preferred lender. Let's start with what builder buydowns actually are, because a lot of buyers hear that term and aren't really sure what it means. A rate buydown is essentially prepaid interest. Either the builder, the seller, or the buyer pays a lump sum at closing in exchange for a lower interest rate, either temporarily or permanently. The most common version we've been seeing is what's called a 2-1 buydown. Your rate is reduced by 2 percentage points in year 1 and 1 percentage point in year 2, and then it resets to the full market rate starting in year 3. So if your going rate is 6.5% today, you might pay 4.5% in year 1 and 5.5% in year 2, and then 6.5% from year 3 all the way forward. The other structure that many builders have been using is a permanent buydown, where they essentially buy your rate down for the full life of the loan. That's the version producing those headline rates near 3% on certain quick move-ins. Quick move-ins are homes that the builder already has under construction or already completed. They need to close on those before their fiscal year ends, and they're willing to subsidize the rate aggressively to make it happen. Here's the backstory on why builders were doing all of this. During 2023 and 2024, the Phoenix area builders were sitting on growing inventory. Rising interest rates had cooled buyer demand significantly, and buyers had a real problem. Homes were built, a lot of sunk cost, and buyers on the fence. Incentives were the only solution. Rate buydowns, upgrade packages, closing cost credits, it worked, and buyers moved product. But the market has shifted and demand has stabilized, and builders' fiscal years typically close in May or June. And as those books close, the math on subsidizing a nearly 3% rate for every buyer gets harder for them to justify when they don't have to. Multiple sources are confirming what I'm hearing directly from the builder's reps. The most aggressive incentive packages are being scaled back. Some have already ended. If you're waiting around to see if the deals get any better, they're not. The direction is one way right now. So here is the real question. If you're sitting in front of a builder today and they're offering you a buydown, should you take it? And the honest answer is, it depends. And you should not sign anything before you do one specific thing. Here's the trap that catches a lot of buyers. Buyers push hard for you to use their preferred lender. They'll tell you the buydown is the only available through their lender, and often that is true. But here's what I tell every single buyer I work with. Get a loan estimate from the builder's lender, and then get a loan estimate from an independent lender on the same exact loan terms. Look at the total cost of that loan over 5 to 7 years, not just the first year payment. Sometimes the builder's buydown genuinely wins, especially on a permanent buydown near 3%. That math is just hard to beat. But sometimes the preferred lender has a higher origination fee, a worse rate after the buydown period, or just less favorable terms that quietly eat into the savings you thought you were going to get. You won't know it until you compare it. The other question worth asking your builder is there any flexibility on price instead of the buydown? In some situations, negotiating a lower purchase price actually delivers more value than a 2-year rate reduction, as a lower price means lower property taxes, lower PMI, if that applies to you, and more equity from day one. Builders typically prefer to give you the buydown because it doesn't permanently reduce the appraised comp value in the community in general. You, as the buyer, need to run both scenarios and decide which one actually helps your financial position more. Here's the bottom line. The window on the buyer incentives is closing in the next 30 to 60 days. If new construction is on your radar for anywhere in Gilbert, Queen Creek, or Santan Valley, now is the time to be actively in the market, not planning to get around to it after summer. Come June, if you want help evaluating a specific builder's offer, running the buydown math, maybe comparing lenders, understanding what's actually in the contract before you sign, that's exactly what we do. And there's no cost to you to have us represent you on a new construction purchase. Visit our website or schedule a call. Just reach out to us. I'm Megan Williams with Blue Collar Homes. Talk to you soon.